Good evening, dear students. Good evening, everyone. Okay, so we have started with the topic of ratio analysis, and we have covered quite a good number of ratios. So let's just recap all the ratios that we have covered till now, and then later on we'll take the discussion further. So first up, we have started with something called as current ratio. So current ratio was simply current asset upon current liabilities. That was indicating your short-term liquidity, right? So that was indicating your short-term liquidity, which means for every 1 rupee of current liability, how much of current assets you have got. Now, higher this ratio, the better it is, because that gives us a better sense of security, right? But, we can't be also having this ratio as a very high number for a simple reason that if the current ratio is very high, it means there is some sort of inefficiency. Now, inefficiency could be with regards to selling, with regards to collecting, and with regards to investing. Ideally, the current ratio should be around 2:1, and if current ratio is less than 1, it indicates negative working capital. Okay, then we said that in spite of being a current ratio of 2, we may face a situation wherein we may face a situation in which what we say, the numbers, I mean, the liquidity of the company may not be just enough, right? It may not be just enough. So we say that there's a need for some other ratio, which was called as a quick ratio, in which we excluded the stock and the prepaid expense. And if we made it even more strict with the absolute liquid ratio, in which we said that in the numerator, instead of taking all sort of liabilities, all sort of current assets, we should be considering only the cash and marketable security. Okay, so then we went ahead with the basic defense interval ratio, which was telling us how many days of cash balance do we have in our balance sheet or in our bank account. Then with regards to equity ratio, equity shareholders funds to net assets, it gives you the proportion of net assets funded by equity shareholders. Debt ratio, it provides us with the proportion of debt, and proportion of net assets is funded by debt. Then we have proprietary ratio, proportion of net assets which is funded by owners. And right, so the debt equity ratio is ratio of debt to equity. Now, all of these numbers are going to indicate how much of long-term solvency does a company have. Then we just discussed about how the how the P&L can actually be bifurcated into two sections, one comprising of the operating part and another portion comprising of the financing part. So operational part, operationally, we can say that the income statement runs up to EBIT. After EBIT, whatever happens with regards to interest or preference dividend, that happens because of the financing part. So EBIT is essentially the earnings that we have for all our fund providers. PAT is the earnings for all the owners, and net profit for equity shareholders indicates the earnings for the equity shareholders. Now, rate of return earned on all funds is going to be EBIT upon total capital employed, which is also called as the return on capital employed. Same way, return on owned funds can be PAT upon owned funds. Rate of return on equity funds will be net profit for equity shareholders upon equity shareholders fund or equity share capital plus reserves. Okay. Now, basically, we saw that this concept called as a rate of return on capital employed and the rate of interest. So if the return on capital employed is less than the rate of interest, then of course taking debt makes sense. If taking debt is not a advisable opinion, because there you are earning less than what you have promised as the rate of return. Whereas return on capital employed, when it is greater than rate of interest, return on capital employed is greater than rate of interest, then it makes sense for you to take a debt because you are earning far more than what you are actually promised to pay. So that degree of financial gearing is what is measured by the ratio of capital gearing ratio, which is simply debt plus preference share capital upon equity share capital plus reserves. Okay. You also know some of the coverage ratios like your interest coverage ratio, preference dividend coverage ratio, debt service coverage ratio, and fixed charges coverage ratio. Now it's time for us to look about something really interesting, And that is, the set of activity ratios, guys. So we're going to talk about the activity ratios. Okay. Now, activity ratios. So what all is included basically in the activity ratios, guys? Okay. Activity ratios. It is going to also called as the efficiency ratio, right? How efficiently, how effectively you are using your assets to generate sales, right? So first up, let's look at one of the ratio called as inventory turnover ratio. Okay, inventory turnover ratio. Now, what's this inventory turnover ratio? So inventory turnover ratio, as the formula states, according to the formula that we have got, inventory turnover ratio is going to be okay. Let me not go to the formula. Let me arrive at it in a bit logical way. Let's say our cost of goods sold. Okay, let's say the cost of goods sold is 36 lakh, guys. Cost of goods sold is 36 lakhs, and the average inventory that we maintain, average inventory that we are maintaining is 6 lakh, right? So cost of goods sold is 36 lakh. Average inventory is going to be 6 lakh. So cost of goods sold is 36 lakh and average inventory is going to be 6 lakh, guys. So now, if I ask you, like, how many times in a year one lot of, how many times in a year one lot of or one lot of inventory is sold? Because we are maintaining a inventory level of what, 6 lakh, right? So COGS is 36 lakh. So can you tell me how many times you would be selling this lot of inventory in a year to achieve that COGS of 36 lakh, guys? Yeah. Can you tell me how many times? How many times, guys? 6 times, right? Because you will say, sir, entire 36 lakh is the COGS and one lot is 6 lakh, right? So the entire lot is 36 lakh. I mean, entire COGS is 36 lakh. And we are having an average inventory level of 6 lakh. So of course, how many times are we really selling one lot of inventory, guys? So it is 36 lakh divided by 6 lakh. Can I say it is 6 times? So we are selling 6 times. We are selling 6 times this average inventory. So 36 lakh is the COGS divided by the average inventory of 6 lakh, which is 6 times. So how many times in a year one lot of inventory is sold? Right. So we are selling like 6 times, right? Correct. So this 6 times is exactly what we call it as the inventory turnover ratio. So how many times your inventory is getting turned over? That is what we are. That is what we are discussing about this, right? How many times in a year the inventory was getting turned over? That was 6 times. Okay. So how many times in a year one lot of inventory sold is 6 times, and that's what exactly called as the inventory turnover ratio. So can you tell me what will be the inventory turnover ratio formula? Can you tell me what will be the formula for inventory turnover, guys? Yeah. COGS upon average inventory. Perfect. That's going to be COGS upon average inventory. Right? Yeah. So this is cost of goods sold upon average inventory. Okay. So we are saying that in a year, we were selling these goods 6 times. So now my question to you is, if in a year we were selling the goods 6 times, right? In a year, if we're selling the goods 6 times, so my question to you now is, how many months is the company taking to sell one lot of inventory? How many months is the company taking to sell one lot of inventory, guys? Yeah, guys. How many months is the company taking to sell one lot of inventory? What is the time period? How many months is the company taking to sell one lot of inventory? Yeah. For one lot of inventory, what is the time period taken by the company? Yeah, 2 months. Perfect. Because we say that there are 12 months in a year, and in a year, there are six turnovers happening. So if there are 12 months and six turnovers are happening, of course, it's going to be 12 divided by 6, which is 2 times. Right? So how many months is the company is taking to sell one lot of inventory? That is going to be 2 months. So company is going to take 2 months to turn around one lot of inventory. So can we just put this as formula as inventory holding period? Right? So inventory holding period is, guys, 12, or if you want in days, it could be 365. If you want in weeks, it could be also 52. Divided by inventory turnover. Okay, I can actually rephrase this also, right? So it's like 12 or 365 or 52 divided by, how do you calculate the inventory turnover? So how do we go about calculating the inventory turnover, guys? So 12 or 365 or 52. How are we going to get this as an inventory turnover then? So we can have it as COGS upon average inventory. So this is going to be 12 or 365 or 52. We can actually make it in a way that since it is divided by COGS upon average inventory, right? We can say this is nothing but into average inventory upon COGS. So 12 or 365 or 52 multiplied by average inventory upon COGS. That's your inventory holding period. Right. So average inventory holding period, we say it is 12 or 365 or 52 into average inventory upon COGS. This is the formula for inventory holding period. You can use either this formula or you can even work out with this formula also. Okay. Perfect, guys. Are we clear? Okay. Now let's go for some more of such activity ratios. Right. So this was about inventory turnover ratio. Same way, we are going to discuss about debtors turnover ratio. So debtors turnover, we can understand it like this. Let's say credit sales is 42 lakhs. And we have like average debtors is 10 lakh 50,000. So credit sales is 42 lakh. Average debtors is 10 lakh 50,000. So now my question is, how many times in a year goods are sold to debtors. So how many times in a year goods are essentially sold to debtors? So can I say this is like 42 lakhs upon 10 lakh 50,000? So how many times in a year goods are sold to debtors? 42 lakhs divided by 10 lakh 50,000. Because you have on an average a debtor value of debtor balance of 10 lakh 50,000 and your credit sales is 42 lakhs. So if your credit sales is 42 lakh and your average debtors is 10 lakh 50, so you're actually selling goods to the debtors 4 times in a year. Selling goods to the debtors 4 times in a year, guys. Noted. So we are selling it 4 times in a year. Now, same lines, if I ask you, what is the debtors collection period? So if it's like you're selling 4 times in a year, if you're selling goods to your debtors 4 times in a year, how much time do you take to collect the money? How much time do you take to collect the money? How much time do you take to collect the money, guys? In months, you can definitely say. Can I say since we have this as 12 months upon 4? So 12 months divided by 4, that's going to be 12 divided by 4, which is 3 months. You are collecting the money in 3 months. Right, guys? So debtors collection period is 3 months. And that's we getting it as 12 months upon 4. Or I can also say that formula wise it is 12 or 365 or 52 divided by debtors turnover. So this is going to be debtors turnover. Then of course the numerators are the same. Now debtors turnover, we didn't write the formula by the way. So how do we get the debtors turnover by formula, guys? So by formula, we can essentially say this as credit sales upon average debtors. Right, so credit sales upon average debtors. So debtors collection period is going to be 12 or 365 or 52 divided by debtors turnover. Right, so debtors turnover, I can definitely say that this is credit sales by average debtors, and this is going to be, I mean, the formula wise, we can say it is 12 or 365 or 52 multiplied by average debtors by credit sales. Right? Got it, guys? Right? So that's your debtors collection period. So you can have the formula as this one or even this one. Now, same line. I'm not just going to now work around with numbers, but I'll ask you simply, can you give me the formula for creditors turnover? What's the creditors turnover ratio is? Yep. Tell me. What's the creditors turnover ratio? What's the creditors turnover ratio? Creditors turnover ratio. Can we say it's going to be credit purchases divided by average creditors? Perfect. Absolutely correct, guys. Now, if I ask you what is the creditors payment period. Creditor's payment period. What will be the creditor's payment period? How do we calculate the creditor's payment period, guys? Creditor's payment period. Creditor's payment period will be on the similar lines, 12 or 365 or 52 divided by creditor's turnover. Or you can also say that it is 12 or 365 or 52. 12 or 365 or 52 multiplied by average creditors by credit purchases. Got it, guys? Yeah. Correct. Okay, good. So these are some of the inventory, the turnover ratios or activity ratios that we were discussing about, right? Now, there are few other activity ratios, which we may not be able to really draw, easy conclusions out of it. But essentially, what we can think of over here is we may not be able to draw proper conclusions about it, but all these activity ratios or efficiency or turnover ratios are going to tell us how effectively we are going to manage it. How effectively we are going to manage it, guys, right? So how effectively are we really going to manage it? How effectively we are going to run the business. That's what is indicated over here. So let's say we have got something called as fixed asset turnover ratio. Fixed asset turnover ratio. So fixed asset turnover ratio is going to be sales or COGS upon average fixed asset. So this is going to tell us, like if you want to draw a simple interpretation, it tells us how much sales is generated using ₹1 of fixed asset. So sales or COGS is simply going to be how much sales is generated using ₹1 of fixed assets. For every ₹1 of fixed asset, how much sales is being generated. Same way, you may have total capital turnover ratio. Total capital turnover ratio is sales or COGS upon average total capital employed. This is going to tell you how much sales is generated using ₹1 of capital employed. So you're going to see how much sales is actually generated using ₹1 of capital employed. Right? That's your total capital turnover ratio. Right? You may also have like working capital turnover ratio. Working capital turnover ratio. Basically, working capital turnover ratio is, guys, sales or COGS divided by average working capital. Right? So this is going to tell us how much sales is generated using ₹1 of working capital. Right? So any turnover ratio, it's going to tell you how effectively you're using that particular asset. Right? So now the question is, right, which one should we ideally take? Should we take sales or COGS in the numerator? Most of the cases, 99.99% of the cases, you will find that the question will specify whether to use sales or whether to use COGS. Right? If there is no such clarity and you have both the information given to us, then you should be obviously taking sales as a number. Okay. So there's quite a confusion, like whether we should take sales or COGS in the numerator. So I would like to say you will have to take sales You'll have to take sales if nothing has been specified in the question. Clear? Are we good, everyone? Yeah. Fine. So these were some of the activity or turnover ratios. Now we will look at profit and loss account or P&L statement ratios. P&L statement ratios. Which are very simple. These P&L statement ratios are all going to be in this general format. P&L statement ratios are all going to be in a general format of COGS. Sorry, not COGS, my bad. They're going to be X upon net sales into 100. Right? So it's going to be like X upon net sales into 100. Okay, so general format is going to be X upon net sales into 100. So for example, if we want gross profit ratio is gross profit upon net sales into 100. Right? The gross profit upon net sales into 100. Then if we have net profit ratio, it is simply net profit upon net sales into 100. Right? Okay, now if I ask you, what is COGS ratio? COGS ratio is going to be COGS upon net sales into 100. Okay, one question to you. Can you think of some relation between gross profit ratio and COGS ratio? Can you think of any relation between gross profit ratio and COGS ratio? Can you think of any such relation between gross profit ratio and COGS ratio, guys? Yeah. Any sort of relation you can think of, guys? What will be the relation between gross profit ratio and the COGS ratio? Any relation that you can think of between gross profit ratio and COGS ratio? Yeah. What's the relation? Since we know something like COGS plus gross profit is equal to net sales, so it's quite obvious that COGS ratio plus GP ratio is equal to 100%. You'll always find this part of thing. COGS COGS ratio plus GP ratio, that's going to be totally equal to 100%. Okay, just keep a note of it. Then, apart from this, we may have something else also like gross profit ratio, and this we can have, let's say, operating expense ratio. So operating expense ratio will be simply operating expense upon net sales, right? So that's going to be start into 100. So operating expense into 100 upon net sales, that's your operating expense ratio. Then you can have like administrative expense ratio. Administrative expense ratio. This is going to be admin expense upon net sales into 100. Right. Then if you have like selling and distribution expense ratio, selling and distribution expense ratio. That will be, of course, selling and distribution expense upon net sales into 100. Selling and distribution expense ratio is going to be selling and distribution expense upon net sales into 100. Then we have a ratio called as operating ratio. Remember, it's not operating expense. We're talking of operating ratio. So operating ratio is COGS plus operating expense upon net sales, of course, into 100. So the difference between operating expense ratio and operating ratio is what? COGS plus operating expense is being considered. So in operating ratio, you consider COGS along with your operating ratio, expenses to arrive at the operating ratio number. Okay. Are we clear till now? Yes, everyone? There guys. Okay, so these are some of the P&L ratios, guys. Right, so these are some of the P&L ratios. Now let us look at something like the market ratios. Okay. Market ratios. Let us say we have two companies, A and B, with their respective net profit for equity shareholders numbers. A is having a net profit for equity shareholders as, let's say, 2,30,000. The other is having 3,20,000. So if I ask you, how do we calculate the earnings per share? Can you tell me what should be the formula for earnings per share, guys? What should be the formula for earnings per share? Yeah. Earnings per share. Earnings per share will be, of course, net profit for equity shareholders divided by number of equity shares. So let's say if we have number of equity shares here as 10,000 and here it is 13,000. So we can definitely say on a per share basis, we are earning 23 and 24.61 or 24.62, right? That's your earnings per share. Now, let's say on a per share basis, company has paid out dividend. Over here, the company has paid a dividend of 8, right? And 8, and let's say here the company has paid a dividend of 10, right? So can you tell me what is the dividend payout ratio? Dividend payout ratio. What should be the dividend payout ratio? Dividend payout ratio it means the proportion of dividend that you are going to pay. So dividend payout ratio is proportion of EPS paid out as dividend. So what's the dividend payout ratio? Proportion of EPS which is paid out as dividend. Proportion of EPS which is paid out as dividend. So how much is the proportion of EPS which is paid out as dividend, guys? Yeah. You want to know what is the proportion of EPS which is being paid out as dividend? Yeah, guys. What's the proportion of EPS which is paid out as dividend? So we can say it is simply DPS upon EPS, right? So dividend payout or just the dividend payout is going to be dividend per share upon earnings per share. So which of these two companies are having a higher dividend payout ratio, guys? Of course, company B is having a higher dividend payout ratio because it is paying out 40.63% of its earnings, right? That's your dividend payout ratio. Okay. Now, let us say after this dividend payout ratio is done, how much is the retention ratio? So retention ratio is going to tell us what is the proportion of EPS retained by company. So what proportion is being retained by the company? Of course, retention ratio is going to be calculated as 100% minus dividend payout, or 100% upon dividend payout ratio. The retention ratio is what? 100% minus dividend payout ratio is, right? Or you can also write it in the form of a formula where we say it is EPS minus DPS upon EPS. EPS minus DPS upon EPS, that's your retention ratio. Okay, guys. Right, so that's your retention ratio. Now, we are looking at dividend yield ratio. So dividend yield ratio is going to be like, what is the percentage rate of return as dividend? So it's like, I'm telling you, let's say the market price for the shares of company A, it is 80, and for that of shares of company B is 96, right? Then what is the dividend yield? So dividend yield is simply going to like you're earning 8 rupees by investing 80 rupees in the purchasing the share. So that's like going to be like what, 10%? And for the other company, it is 10.42%, right? So dividend yield ratio is going to be calculated as dividend per share upon market price per share. Dividend per share upon market price per share. That's a dividend yield ratio. Then we have earnings yield ratio. So earnings yield ratio is simply going to be EPS upon MPS. So this is going to be like stated as what? Percentage rate of return as EPS, you can say. Right. So this is your earnings yield ratio, or compared to that, the dividend yield ratio. So dividend yield ratio is DPS upon MPS. Earnings yield ratio is EPS upon MPS. Got it, guys? Yeah. Now, one important ratio is called as price to earnings ratio, or what we call as also the P ratio. Price to earnings ratio or P ratio. Now let's try to understand what's this P ratio. Now, as the formula says, it is MPS upon EPS. What is the interpretation of this? Let's first try to calculate the P ratio here. So P ratio is what? Market price per share divided by earnings per share, which is 3.47 over here, and here it is 3.9. So understand that for both of these companies, we have computed the P ratio as 3.48 and 3.9. So for company A, investors are ready to pay 3.48 times of its earnings. For company A, EPS, I mean for company A, for every 1 rupee of for rupee 1 of EPS, investors are ready to pay rupees 3.48 as price, right? And same way for the other thing, it's like for every 1 rupee investors are ready to pay 3.9 as the price. Right, so this is 3.48, and for this, they're ready to 3.9. So, as per your understanding, what do you say? Which of these two companies enjoy a better investors' confidence? In which of these two companies, investors are having a higher degree of confidence? In which of these two companies, investors are having a higher degree of confidence, guys? Where do you see investors are having a higher degree of confidence? Yeah. Where do you see that the investors are having a higher degree of confidence? Of course, it's company B, right? So investors confidence, here it is of course low, and here we have this as high. So investors confidence is high in case of company B. Investors confidence is going to be high in case of company B. So higher the PE ratio, greater is going to be the investors confidence, guys. Are we good till now, everyone? Yes. Are we all good? Okay, good. Fine. So we have covered like substantially most of the ratios, but one concept is pending, guys. Something called as the concept that I'm talking of is what we call as a um, Dupont chart or Dupont analysis. Let's do that part. Once that is done, then we'll take a break, and then after that we'll come back and start with the questions. So Dupont analysis. Okay, Dupont analysis. This is going to be a ratio, or this is going to be an analysis in which essentially we are going to uh, break the entire part. Okay, which is, essentially we are going to break the entire analysis into, the return which the equity shareholders are getting into multiple factors, right? So that we can identify in which area the particular company is strong or which area the company is not so strong. Okay. So what we do is we break the return numbers into multiple parts. So let us say return on equity. What was the formula for return on equity, guys? What is the formula for return on equity? Hmm? What is the formula for return on equity, guys? Yeah. Return on equity, not return on capital employed. Formula for return on equity, guys. What is the formula for return on equity? Hmm. Can say it's net profit for equity shareholders, right, upon equity shareholders fund, right? I can actually break it into two parts. One is net profit for equity shareholders upon sales and multiply it by sales upon equity shareholders funds. So can I say I just broke this into return on equity into net profit ratio multiplied by uh, equity turnover, right? So we just multiply this as net profit into equity turnover. So here, this particular portion is going to tell us how much is your margin, right? And the second part is going to tell you net profit ratio is going to tell you how much is the margin. And the second part is going to tell you with regards to equity turnover, how much is the activity that you are undertaking. Okay. So you can have a higher return on equity with a greater amount of net profit margin, higher amount of equity with a greater amount of net profit margin, or with a higher level of equity or higher level of turnover or activity. So for example, let us say we have got two companies, X and Y. Both are having a return of equity of 20%. Right? Both of them are having a return on equity of 20%, right? But there should be something that is setting them apart. So I just look at what is the net profit ratio and equity turnover. I find that for company X, net profit ratio was 10% and equity turnover was 2 times. Whereas for the other company, net profit ratio is 8% and the equity turnover is 2.5 times. So with regards to net profit margin, with regards to the profit margin, which company is having a strength? Which company is strong as far as the net profit margin is concerned, guys? Which company is strong as we compare, both out of both the companies, which company is strong when it comes to margin? Yeah, guys. Which of these companies, I mean, when it comes to net profit margin, company X is strong, right? So company Y is basically weak, right? So net profit margin, if I look at it, so this is a strong point over here, right? Whereas the company is weak over here. But when it comes to activity or efficiency of using it, uh, X company is weak, whereas Y is going to be strong. X is going to be weak and Y is going to be strong. Okay, that's your net profit margin and the activity, right? So, of course, if company Y is able to attain a higher profit margin, can I say it will be able to generate a higher return on equity? Like if you would like to advise company X and Y, I would say that company X should work on selling more. They should put more money on advertisement or maybe some sort of promotional activities, which will enable their sales to be rising at a faster pace, right? But whereas company Y should actually work on reducing its cost, which will ensure that the net profit margins are appropriately, at a higher level. Okay, got it, guys? Yeah. Okay. So that's your return on equity being classified into two parts. Okay. By the way, we can further take it to one more downside. We just take it as what? Net profit for equity shareholders upon sales, but we further multiply it by um, sales upon total capital employed and further multiplied by total capital employed upon equity shareholders, right? So this part is going to tell us what is the profit margin that we have. Second part is also going to tell us how much is the activity. Third part is going to tell us what is the level of gearing that we are having, because we would like to know what is the amount of total capital employed as compared to equity shareholders fund. Right? So return on equity, it will be like net profit for equity shareholders upon sales, and this is going to be multiplied by sales upon total capital employed, which is the activity ratio, and total capital employed upon equity shareholders funds, which is gearing. Right. So these are the three different parameters that we can think from the company performance point of view. So if the company is to generate a good amount of net profit, I mean return on equity for its equity shareholders, it should work on these three aspects. First, the margin. Second is activity, which is basically utilizing the assets to the better extent, right? And then, of course, you should be also looking at the gearing part also. Okay, should be also looking at the gearing aspect, right, guys? Right. So if you want a higher return on equity, first up, you should be working on higher margins. Second, maybe attain a higher degree of turnover with the level of activities. And thirdly, you should be also looking for the benefit of gearing, which is basically taking debt for raising, for funding your business, which will ultimately lead to higher capital infusion and maybe generate a good level of returns for the equity shareholders. Okay. Looking at these numbers, if I ask you, with regards to net profit margin, which is strong thing, with regards to activity, which is a strong, which company is having a strong point, and with regards to gearing, which company is having a stronger point. Yeah. With regards to net profit margin, of course, X is strong and Y is going to be weak. And with regards to activity, which one is strong, guys? With regards to activity, or turnover ratio, this is weak and this is strong. Gearing part, here it is weaker and here it is stronger, right? So if I ask you, out of these two companies, which is having a greater financing risk? Which of these two companies are having a greater financing risk, guys? Tell me. Which of these two companies are having a greater degree of financing risk? Is it company X or is it company Y? Yeah. Financing risk is, of course, higher in case of Y, and this is low in case of X. Okay, yes, the financing risk is definitely higher in case of Y and it is low in case of X, because the gearing is higher in case of Y, guys. Okay, got it, everyone? Okay, so we're getting the answers. Okay, perfect. She's there. Hmm. Okay. Now, before we go for the questions, let's just try to, solve certain things as MCQs. Okay. So we have got like two more MCQs. Let's solve those two MCQs and then we'll take a break. And then after that, we'll come back with the questions to solve. So let's try to answer question number 3, guys. Question number 3. So Z Limited has the following balances: equity share capital 40 lakh, reserves and surplus 10 lakh, 12% debentures, long-term bank loan of 20 lakhs, trade payables is 8 lakh, outstanding expenses is 2 lakh. Assume long-term debt is equal to debentures plus long-term bank loan, shareholders funds is given, long-term liability is given. What will be the debt equity ratio, guys? So debt equity ratio will be debt. So debt is what? Long-term debt of 20 lakh plus debentures of 30 lakh divided by equity value. So equity is what? Equity plus reserves, which is 40 lakh plus 10 lakh. So it is 1. And when it comes to total debt ratio, that's going to be total debt. So total debt is again 50 lakh, right, divided by 50 lakh plus 50 lakh, which is 0.5. So option A is correct. Okay. Then answer this question. This one. For the year ended 31st March 2025, A Limited reports sales of 1 crore 50, cost of goods sold and operating expenses, which is excluding depreciation and interest, is 1 crore 5 lakh. Depreciation is 9 lakh. 10% debentures is 30 lakh. Term loan at the rate of 12% is 20 lakh. You have to compute the interest coverage ratio. So interest coverage ratio will be, of course, EBIT. So earnings before interest and tax will be 1 crore 50 lakh minus 1 crore 5 lakhs minus depreciation of 9 lakh. That's your EBIT. And what's the interest? Interest is 30 lakh into 10% plus 20 lakh into 12%, which is 5 lakh 40. So if you look at the coverage ratio, that's coming out to be what? 6.67. Second, 1 crore cost of goods sold and operating expense, 1 crore, 5 lakh is subtracted, depreciation is that. And then we have here 30 lakh into 10% plus 20 lakh. 20 lakh into 12%. So that's 54 lakh. And this is 6.67. So the turnover ratio, sorry, not turnover, the interest coverage ratio is 6.67. Yeah, so there is some problem with this. So option D is correct. Okay, perfect. So with that, we are through with a good number of, MCQs and so what do you say, the questions, the ratios. Now, let's just take a break, guys, break of around 15 minutes, and then we'll come back and we'll start with, the MCQs. Sorry, not the MCQs, my bad. The certain questions that we need to solve. Okay, let's take a break, guys. See you after the break. Bye-bye. Okay, let's begin, guys. Yeah. So let's start with the questions, guys. Okay, here we have this question over here, guys. We have to calculate certain ratios from this. Yeah, guys. From the following balance sheet of Z Limited, we have to compute current ratio, liquid ratio, stock to working capital, capital gearing, stock turnover, debtors turnover, and collection period. Numbers are given along with the balance sheet. Would you like to try it, guys, quickly? You know the ratios, you know the formula. Would you like to try it on your own? So I can give you like um, yeah. Okay. So for that, just a 5-minute timer. Okay. Let's try it out, guys. Okay. So let's look at the solution, guys. Okay, so first the current ratio. So current ratio is current assets upon current liabilities. So current assets is totaling to what? 3 lakh. Current assets is essentially 2 lakh plus 3 lakh 80,000 plus 3 lakh 60,000 plus 60,000. Current liabilities is
Next week भी अच्छी तो मरे यही
so current liabilities are 3,20,000 creditors and 80,000 bank overdraft. So yeah, so current ratio works out to be what? 10 lakh divided by 4 lakh, which is 2.5. And then liquid ratio. Liquid ratio is current asset minus stock minus prepaid expense upon current liability. So current asset was 10 lakh. Right? From that, we have to subtract the stock value, which is 3,80,000 and 60,000, and then divide it by 4 lakh. Right? So liquid ratio is what? 5 lakh 60 divided by 4 lakh, which is 1.4. Right? Liquid ratio. Then we have stock working capital. So stock to working capital, we have stock of what? 3 lakh 80,000 upon working capital will be current asset minus current liabilities, which is 10 lakh minus 4 lakh. So this is 3 lakh 80 divided by 6 lakh, which is 0.63. Okay. Then we have stock working capital gearing ratio. Capital gearing, it is going to be preference share capital plus the debentures. So it's 3 lakh plus 1 lakh 60. So that's 3 lakh plus 1 lakh 60,000 upon share capital and reserve. So share capital is 6 lakh 40,000 plus capital reserve of 60,000 plus general reserve of 2 lakh and also P&L of 20,000. So capital gearing is 0.5. Okay, so capital gearing is done. Then stock turnover. stock turnover will be, we know it is COGS upon average stock. So COGS can be computed over here, sales minus the gross profit. The gross profit was 25%. So COGS is, sales is 20 lakhs into, since the GP ratio is 25%, this is 75% upon average stock. So average stock is basically opening and closing average. So it is 1,20,000 is the opening, closing is 3,80,000. So 1,20,000 plus 3,80,000 divided by 2. So stock turnover is 20 lakh into 75%. And this is average of 1,20,000 and 3,80,000. So we have the stock turnover as 1,50,000 divided by 2,50,000, which is 6 times. Stock turnover is 6 times. Then debtors turnover. So debtors turnover is credit sales upon average debtors. Right. So credit sales is given to be 20 lakhs. Average debtors will be again what, 3,60,000 plus 40,000. This is 3,60,000 plus 40,000 divided by 2. So this is essentially 20 lakh divided by 2 lakh. So 20 lakh divided by 2 lakh. That's 10 times debtors turnover. And then it also asks about the collection period. So debtors collection period will be 365 divided by 10, which is 36.5 days. Right. So did we get these numbers, everyone? Just look at the ratios. Did we get these numbers, everyone? Meet has got, then Kuldeep, capital gearing 1.76. Capital gearing 1.6, no, it's 0.5. Video and voice not audible. That might be earlier. Got it? Okay, fine. Then let's go for another question. Try out this question, guys. Yeah, try out this question. Yes, Astha.
Good evening, sir.
Good evening, Astha.
Sir, I have doubt in debt ratio.
Yeah.
Sir, in book it is written that we also have to take the short-term liabilities. So why we
Short-term
are
loan.
not taking trade payables?
No, trade payables is not going to be the debt ratio. Short-term loans, if you have, then you will consider that.
Sir, in the illustration also we have taken the accounts payable in calculating debt equity ratio.
Debt equity ratio. Debt ratio or
Yes, sir.
equity ratio?
total debt to net worth.
Debt to net worth.
Yes, sir.
So debt to net,
Illustration 5.
so if it is debt to net worth, then you will take the entire liability part.
Okay, sir. So don't we have to take the accounts payable?
Accounts payable, if it is debt ratio, you will not take. But if it is debt to net worth, then you will take.
Okay, sir.
Yeah. Okay, guys, try out this question number 2 as an example. Did we use COGS in stock turnover because there was gross profit given in stock turnover? Yes, stock turnover will always be COGS. Yes, Aditya.
Hello.
Yeah, Aditya.
Sir, voice is not audible and video is some not clearly. Some cut also there. Video is not audible and voice, sir.
Video is not
Voice
audible.
is some technical issues also shown, sir. Yes, sir. Yes, sir. What voice and video?
Voice is clear, no? Now you can see. Now you can see and you listen to me, right?
Sir, no, sir. And
Hmm?
what, sir?
Can you see and listen to me now? It
No,
is
sir.
fine.
No, sir. But voice is some.
No, I don't think there's some issue from your end then. Because I don't think someone else is facing it. Everything is clear because others are saying everything is fine. So I think there's some network issue from your end. Just check your internet connection. Yeah, guys, try this out. Maybe I can just give another 5 minutes for this. Try it, guys. Okay. Long-term loan, you got it. Capital employed. Okay, let me answer it quickly. So we have a capital gearing ratio, we have a debt equity ratio, right? So here, when we look at capital gearing ratio, it's going to be debt plus preference share capital upon equity share capital plus reserves. And we know that this is given to be 0.75. So this ratio is 0.75. Okay. That's a capital gearing ratio. Now from here, we know the share capital amount and we know the preference share capital. Preference share capital. So we know the debt plus preference share capital of 1 lakh upon equity share capital is 3 lakh plus reserves, and this is 0.75. This is one part. And the other ratio that we have is debt equity. So the debt equity is simply going to be debt upon equity shareholders fund. So we have debt, something which we don't know, but we know the equity shareholders fund is going to be 3 lakh of share capital plus reserves, and this is going to be equal to 0.4. So there's a two variable equation coming out over here, right? So two variable equation. So we get this as debt plus 1 lakh is equal to 3 lakh into 0.75, which is 2,25,000 plus reserves. And debt upon equity plus reserves is 0.5. So debt is equal to 3 lakh into 0.4, which is 1,20,000 plus 0.4 times of reserves. Okay, so we can definitely say that debt is equal to 1 lakh coming on this side, so that's getting subtracted. So 1,25,000 plus reserves. And here we have debt is equal to 1,20,000 plus 0.4 reserves, right? So we can just say this is equation 1 and this is equation 2. So we're just going to equate both of them. Equate 1 and 2. We have 1,25,000 plus reserves is equal to 1,20,000 plus 0.4 reserves. So we may have like what? Reserves minus 0.4 reserves is equal to 1,20,000 minus 1,25,000. So it's like what? 0.6 reserves is equal to 5,000. So the value of reserves is 5,000 divided by 0.6. No, there is some problem over here. I think there is some problem. So debt plus preference share upon equity share capital plus reserves is 0.75. And debt to equity is debt upon 3 lakh plus reserves is 0.4. So debt is 3 lakh into 0.4, which is 1,20,000 plus 0.4 times of reserves. And here we have debt is debt plus 1 lakh upon 3 lakh plus reserves. There is some mistake, I think, that we have committed. Yes, Balamurugan.
It's 0.75 reserves.
Sorry. Yeah. Yeah.
It's 0.75 reserves.
This will be 0.75 reserves. So even over here, we'll have this as 0.75 times of reserves. So this is 0.75 reserves So this we have 0.75 reserves minus 0.4, which means and this is also what, 1 lakh, 3 lakh, 1 lakh 25,000. This is still some mistake. I think 0.75, this is 0.75 reserves. Debt plus 1 lakh is 2 lakh 25,000 plus 0.75 reserves. So debt will be 1 lakh getting subtracted, 1 lakh 25,000 plus 0.75 reserves. And here we have 1 lakh 20 plus 0.4 reserves. So reserves are going to be what? 0.75 reserves minus 0.4 reserves and is equal to, so this is what, 0.35 reserves. Yeah. 0.35 reserves. There is some other mistake, I think. 1 second. 0.35 reserves. So 14285. 5,000 divided by 0.35. Wait. Some mistake. So reserves are working out to be what? 5,000 divided by 0.35. Yeah, 14286. So reserves is 14286. And therefore, what will be the value of debt then, guys? You can use either of the numbers, either of the formula for debt. So it will be 1 lakh 20,000 plus 0.4 times of reserves. So finally, it is 1 lakh 20,000 plus 0.4 times of 14286. So debt is 1 lakh 25,714. Yes, Asta?
Sir, reserves will be negative.
No.
1 lakh 20 minus 1 lakh 25.
1 second. Yeah, coming up to be negative, right?
Yes.
No, I think there is some mistake in the question, I suppose. Just wait. we had this 0.75 as what? 1 lakh plus debt upon 3 lakh plus reserves is 0.75. And okay, so there was this mistake, guys, because the question clearly stated we have to take shareholders' funds. So when you say shareholders' funds, includes even the preference shares, guys. So I need to consider the preference share capital also here, right? So this is going to be now. So preference share capital. This will be 1 lakh. So debt will be 1 lakh 20 plus 0.4 reserves plus 40,000. So we get the equation as 1 lakh 20,000 plus 0.4 reserves. Rather, I'll say this is 1 lakh 60,000. Right? So now let us equate them. I think that should be giving us the answers now. Yeah, so we have 0.75 reserves plus, debt is equal to 1 lakh 25,000 plus 0.75. And here we have debt is equal to 1 lakh 60,000 plus 0.4 reserves. Now we can equate them. So there was one thing that we missed in the question. Yeah, so let's bring, it's like what, 0.35 reserves is equal to 1 lakh 60,000 minus 1 lakh 25,000. This is, yeah, reserves is 0.35. So we have debt as 1 lakh 25,000 plus 0.75 into 1 lakh. So debt is 2 lakh. Okay. Got it, guys? Yeah. Okay. Look at this question 3, guys. Try it out.
बच्चा संभालियो नहीं तो Dupont है ना.
Try out this question 3. We just have to get the average correction period and the debtor's turnover. Okay. So here we go. So we have the average inventory. Average inventory 3,60,000. Inventory turnover is 6 times. So inventory turnover is 6. This is calculated as COGS upon average inventory. So this is 6 is equal to COGS is something which you have to calculate. And we have the average inventory of 3,60,000. Right. So COGS stands as 3,60,000 multiplied by 6, which is 21,60,000. We have the GP is 10%. Gross profit is 10%. So gross profit is 10%, guys. So we know the COGS ratio. COGS ratio is 90%. Right. So of course, we know this 90% is arrived as COGS upon sales. So this is 90% is equal to COGS of 21,60,000 upon sales. So we got a sales value of 21,60,000 divided by 90%. Sales is 24 lakhs. Okay. Sales is 24 lakhs. Now we have the credit sales to total sales. Credit sales is 24 lakhs into 20%. So 24 lakh into 20%. Okay. So 4,80,000. And your debtors is what? 2,30,000. So debtors turnover is credit sales divided by debtors, which is 2,30,000. So debtors turnover is 2.09 as a debtors turnover. And then we have the debtors average collection period. So average collection period is 365 days divided by this debtors turnover. So 365 divided by 2.08, this is going to be 175 days. Okay. Fine. So that's your average collection period, which is 175 days. Okay. Fine. So with that, we are through this question. This was question number 3. We have done 3 questions today. And almost all the ratios are done except 1 or 2, which we'll be discussing it in the next class. So till then, let's just stop here for the day. No, this is not an MCQ. This is a full-fledged question over here. Okay. So let's just stop here, guys. See you in the next class. Yes, Asta.
Sir, in daily operating expenses, we will deduct prepaid and add outstanding if there is any for the year.
Yeah, because we take the cash expense only.
Okay, sir. Not paid. It is accrued cash expenses.
Yeah.
Okay, sir. Sir, in current assets, we take deduct the provision also Debtors minus provision, net value to take.
Yeah.
Okay, sir. Thank you, sir.
Okay, so let's stop here, guys. See you in the next class. Bye bye. Take care.
Recording stopped.